Good afternoon, everyone. Welcome to the Larking Gowen Tax and Budget Review webinar. Thank you for joining so promptly. We'll just leave it a couple of minutes for everyone else to join. We're just waiting for a few others to join the webinar, and then we'll start the proceedings. Thank you. Good. I think everyone's joining, so thank you very much for being so prompt. As I say, welcome to the Tax and Budget Review webinar. My name's Richard Proctor. I'm a tax partner at Larking Gowen. It's my pleasure to welcome you to this review of the budget speech which we heard yesterday. I'm joined today by a panel of experts, you'll be pleased to know, who will be taking us through the main announcements that we heard yesterday, and also catching up on some of the measures that were announced in March in the budget earlier in the year. Just some administration points. You're all on mute today, so please input your questions via the question box, and we'll look at those as we're going through the webinar, and we'll try and answer as many of those as we can. The presentation does include some polls, so we'd be very grateful if you would engage and participate with those. It's great to get your feedback, and it helps to enliven the debate, if you like. And also, just to let you know that there will be a recording of this webinar along with our budget brochure available on our website after this presentation. So if you have colleagues or contacts who wanted to join us today but are unable to, then please let them know that they will be able to catch up via our website. So in terms of the panel today, I'm delighted to say that we're joined by Chris Richardson, Senior Manager in our private client team, Dominic Carter, Tax Director in our Tax Advisory Group, and Sally Farrow, Private Client Partner. So without further ado, I'll introduce Chris.
Thanks, Richard. The first thing I want to say is there is some good news in the budget announcements. This is that the widely touted changes to capital gains tax and IHT have not happened. Tax collected from CGT has increased by 62% over the last 5 years and stands at £11 billion for 2021, while receipts for IHT now stand at over £6 billion. However, these sums are modest compared to the tax big hitters of VAT and employment taxes. Now, a couple of months ago, the government announced changes to national insurance, or NIC, in the run-up to the introduction of the new health and social care levy. From 6th of April 22, NIC charges will increase by 1.25%. These will apply to all iterations of Class 1 NIC, which applies to employees and employers, and to Class 4 NIC for the self-employed. However, there will be no changes to Class 2 national insurance, which is the other NIC charged on the self-employed, or to the voluntary Class 3 NIC rates. This slide summarises the new rates which will apply from 6th of April 22, and I'll leave you to go through the table in your own time. The temporary increase in NIC will then be replaced in April 23 with the new health and social care levy, and NIC rates will then revert to their 21-22 rates. There are a couple of takeaways from this. Firstly, the new levy will apply to those who are above the state pension age. These individuals are currently exempt from NIC, so this will be a new burden for them. Secondly, this change is anticipated to raise over £11 billion per annum. To complement the 1.25% increase in NIC rates, the tax rates for dividends will increase by the same amount across the board for basic rate, higher rate, and additional rate taxpayers, as shown in the table here. Tax charges on dividends only arise once annual dividends exceed the dividend allowance of £2,000. Dominic will shortly explore the impact of these changes on how company shareholders extract profits from companies. One possibility, of course, is to accelerate dividend payments to before April 22, but that will, of course, also accelerate the payment of any tax due to HMRC and may well have an impact on payments on account, and we can advise on the possibility of reducing these if a reduced dividend or reduced other income is paid or received in the following year. Moving on to look at capital gains tax reporting. In 2015, a 30-day non-resident capital gains tax return was introduced for disposals of UK land and property. This was expanded from April 22 to another 30-day return. This applies to UK residents to report UK residential property disposals. However, for UK residential property sales by UK residents, the vendors will now have 60 days to report the disposal and pay an estimate of the tax rather than 30 days. And in mixed use properties, so that's properties where you've got a mixture of residential and non-residential, only the residential element is reported on the now 60-day capital gains tax return, and the non-residential element is reported on the annual self-assessment tax return as before. Pleasingly, the increase from 30 days to 60 days applies to both UK and non-UK residents. For non-residents, the 60-day timeframe also applies to the disposals of all UK land and property, including indirect disposals, so not just residential property. And the penalty structure beyond the 60 days remains the same. We now have our first poll. So the question here is, penalties for missing the 30-day deadline netted HMRC how much over a 6-month period in 2020? 575,000, 895,000, or 1,300,000. Just wait for a few minutes for people to vote. A bit of a mixed opinion there. The actual correct answer is 1,300,000, and that arose from over 12,000 late filing penalties, which is quite a large number over a 6-month period. So moving on, where HMRC discover that tax has not been paid, they can make assessments to collect the tax and to charge penalties and interest. In recent years, there have been numerous attempts through the courts to challenge HMRC's ability to raise assessments. Some of these attempts have been successful, and while they don't undermine HMRC's general ability to raise discovery assessments, the government is now proposing that further legislation will be introduced which enables assessments to be raised even in circumstances which the courts previously said could not apply. The areas of concern that HMRC are focusing on here are unpaid tax arising from the high income child benefit charge, gift aid donations, and a number of pension charges. There will also be some technical changes to the legislation to ensure that the requirement for an individual to notify chargeability to income tax works as intended. Moving on to pensions, in 2006, if you were 50 or above, you could access your pensions. This was changed to age 55 in 2010 and will now be increased again to the age of 57 in 2028 to coincide with the increase in the state pension age to 67. The Office of Tax Simplification is reviewing changing the tax year end date from the current 5th of April. Two possible dates are under consideration, 31st of March and 31st of December. No change is expected immediately, However, there is clear appetite to consider this further as a long-term change, and there is currently no clear indication as to which of these two alternative dates is the preferred one. Benefits from a change may arise, such as simplification and alignment with other countries, most of whom use calendar year reporting already, and this would potentially come at some administrative and management time costs. The Office of Tax Simplification consultation is ongoing, so watch this space. In the run-up to the introduction of making tax digital for income tax, which Sally will talk about later, the government will introduce changes to the way in which non-corporate businesses calculate and pay their tax. This only affects self-employed traders, partners in trading partnerships, and other unincorporated entities with trading income who draw up their accounts annually to a date other than 5th of April or 31st of March, dates which are currently considered to be the same for this purpose. The changes therefore won't impact 93% of sole traders and 67% of partnerships who already account to 31st of March or 5th of April as the year end. The changes will entail significant one-off and ongoing costs and administrative burdens for those affected. So what are the changes? Well, currently, the profit or loss for affected businesses to be declared within a tax year is that to the accounting date falling within the tax year. But going forward, the profit or loss to be declared will be that arising in the actual tax year itself. So, take a business with a 31st December year end. Currently, the profits of the year to 31st December 21 will be taxed in the 21-22 tax year. Going forward, the profits which are taxed in a tax year are apportioned from the two accounting periods which fall into or over the tax year. The transition into the new regime will take place in 23-24 tax year and will be in full effect from the 24-25 year. Key takeaways from this are that businesses need to understand the impact of the proposed changes in advance of the transition year. One possibility is to alter the current accounting period to align with the tax year end or 31st of March, but there is no obligation to do so. But for some businesses, this may in any case not be practical. The tax year to 5th of April 24 is, as I mentioned, the year of transition to the new system, and it is widely expected that for some businesses, the impact in this year will be an increase in the overall level of tax which is paid. Having a proper understanding of the impact of any overlap relief from previous years and the ability to spread some profits is going to be key. I will now hand over to Sally.
Thanks, Chris. So whilst it wasn't part of the budget announcements yesterday, we thought it would be helpful just to give a brief update on Making Tax Digital. MTD has been talked about for a number of years now, and the first phase became mandatory in April 19 for VAT registered businesses where they were above the VAT threshold. They are now having to keep digital records and send their VAT returns to HMRC using MTD compatible software. We have some further significant milestones approaching, and I will talk through those, which will help put into context some of the basis period reforms that are being proposed, which Chris has just talked about. So to start, just a recap on why Making Tax Digital has been introduced and being further extended to cover other taxes. HMRC wants there to be wants to transform the tax administration to make it more efficient, more effective, and easier for taxpayers to get their tax right. Ultimately, the longer term aim is also to enable them to collect tax more frequently throughout the year, similar to how if you're an employee, you're taxed through PAYE. It's worth mentioning that isn't part of the legislation changes that are coming up, and as I say, that's a longer term aim of HMRC. So what's next in terms of MTD? The next significant milestone is April 22, when VAT registered businesses with either with a taxable turnover below the 85,000 VAT threshold will be required to follow MTD rules for their first VAT return starting in or after April 22. The changes I'm going to focus more on today is the changes that we will see in April 24 and April 25, which is the extension of MTD for income tax. This will be referred to as MTD ITSA, which stands for Income Tax Self-Assessment. So in April 24, if you are in a self-employed or a landlord with annual business or property income above £10,000, you will need to follow the rules for MTD ITSA from the next accounting period starting from April 24. This will be further extended in April 25 to cover unincorporated partnerships as well, where the income again is above the 10,000 threshold. We expect that MTD for corporation tax will follow at a later date. April 26 is the earliest date we expect at this time, but this will still be subject to a consultation period and then legislation being put in place. So I think it's watch this space, and we will obviously keep you updated as that develops. So focusing on MTD for ITSA, this will apply to self-employed and landlords to start with who have the annual business and or property income above £10,000. It will apply to your gross income or turnover, so it's not a profit test, and it applies to your total income. It's best explained with an example. So if you're an individual that has £6,000 of gross rental income, but you also operate as a sole trader and say have £7,000 of sales, you will exceed the limit and be within the scope of MTD ITSA. So you look at your combined turnover, you don't look at separate businesses in isolation. MTD will therefore apply for your next accounting period starting after or on 6th of April 24. And as I say, general partnerships are delayed until April 25. There are some exemptions. The most significant exemption is that currently trustees and executors will not fall within the scope of MTD for ITSA. So if you have trustees, executors that have rental income or are part of a trading partnership or sole trade, they will not fall within the scope from April 24. It's possible that they will be included at a later date, but there's no indication from HMRC at this time whether this is a permanent exemption or temporary. What we do know for partnerships is, as I say, from April 25, partnerships that just have individuals as a partners will join, but all other partnerships, such as those that have corporate partners, limited partners, or operate through an LLP, will be required to join at a later date. That date has not yet been confirmed. So again, it's a watch this space. There are some other exemptions, and these will be familiar to people that are already caught by MTD for VAT. They remain the same for ITSA when it's introduced, and you can see the details on the slide. It's understood that if a business is already exempt from making tax digital for VAT because of one of these exemptions, they will automatically be exempt from MTD for ITSA. So how will it work? Individuals will now be required to keep digital records. They'll need to sign up for an account with the government gateway via HMRC to register for an MTD ITSA account. They will then need to send details of their business and rental income and expenses on a quarterly basis. That quarterly basis needs to be as accurate as possible, but it's acknowledged that likely until the end of the year, when you do your final business and rental accounts, that you'll get the true reflection of what your profit or loss may look like. Once you get to that final stage, you will then need to submit a final declaration. It's worth noting that that declaration replaces the traditional self-assessment tax return that you currently file. You'll no longer need to do a tax return. It will be this end of year Making Tax Digital return instead. However, we do expect that that return will have to include all the similar information that normally goes onto your tax return to make sure you're reporting all other sources of income and claiming any reliefs that you might be due. So effectively, those taxpayers that are now within the scope for MTD ITSA will replace the normal self-assessment tax return with 5 new reporting obligations during and after the tax year. The first return will need to be submitted the 4th month after the end of the tax year. You can elect to do it on a calendar year basis, which would mean you would report to the 31st of March rather than 5th of April. But there aren't any other options to spread or change how you report, which is what then links into the basis period reform that Chris referred to. When we first had draft legislation and guidance coming through on MTD, it was clear that for some people, they wouldn't just be doing the 5 reporting requirements. It could be way in excess if, say, they had rental income that had a 5th of April reporting date, but they operated their trade through a different year end. Again, as Chris said, people can still have a different year end, even with the basis period reform, but you really will have to report your profit or losses in accordance with the tax year. I think it's worth just going through the first year as an example, just to go through the dates that people will need to bear in mind. So the first return will be due by the 5th of August 24, and which will cover the period 6th of April 24 to 5th of July. So effectively you have a 1-month period to submit your quarterly return. The second return is due on 5th of November, which covers July to October. You'll then, in that first year, will still have your self-assessment tax return for the previous year that needs to be filed, and that will have the normal 31st of January 25 filing deadline. Shortly thereafter, you'll then have to turn your attention to your third return of MTD, which needs to be filed by the 5th of February, which covers October to January. You'll then do your final return on by the 5th of May, and then you'll have this end of year return that captures all your other income and reliefs, which will have the normal filing deadline of 31st of January 26. So that's what's coming. HMRC have delayed. So originally, until last month, we were expecting the first phase to come in April 23, but there was an announcement by the government last month that this was extended to April 24. However, our advice is, don't delay, and make sure that you are prepared and are taking this seriously now, because it's not just about making sure that you are MTD compliant. There are also other benefits in terms of making sure that if you're operating as a business, that you're embracing the technology and keeping digital records. Some of the benefits are up on the slide. Often our clients will say to us that they don't have enough time to deal with matters, they don't have a handle on their affairs in real-time information, or they just hate paperwork and it gets put off. All these 3 things can be overcome if you actually embrace the technology and maintain digital records using one of the cloud accounting softwares that are available. Software such as Xero or QBO can deal with all this and take away a lot of the headaches that you face as business owners. If you can use a smartphone, you can be a competent bookkeeper. What's more, the entries can be automated to make it time savings that you can generate from this. It's not expensive, so that isn't a barrier to being able to look at cloud accounting as a solution for your business either. Actually, it's the weekly cost of one of these software packages is equivalent of a your favorite coffee from Costa or Starbucks. So cost really shouldn't be a barrier to getting on and embracing what's available. We have teams that are dedicated to this. If there's something you want to talk about, then contact your normal advisor. They'd be able to put you into touch with one of our digital experts, and we'd happy to discuss it further. I will now hand over to Dominic, who is going to go through some of the business tax changes.
Thank you, Sally. I'll be taking you through some of the changes to business taxation as a result of this budget and the spring budget, and consider the impact of some of these changes on some of the perennial tax planning questions that we ask ourselves. The Chancellor made few significant announcements in respect of business taxes, perhaps because we're still digesting the announcements from the spring budget. It was, however, noted that the annual investment allowance would remain at £1 million for companies and unincorporated businesses until April 2023. And whilst this may be a hugely welcome development for businesses, it's quite frustrating for tax advisors who've been practicing the calculations that are needed to deal with periods with non-December year ends, based on an assumption we'd be reverting to a £200,000 limit from January. But joking apart, that is an extremely helpful development. Mr. Sunak was keen to remind us of the super deduction for companies, which is currently in place from April 2021 for 2 years. And to recap, this is a temporary measure to provide an enhanced relief for purchases of new plant and machinery at a rate of 130%. There is also a special rate super deduction of 50% for certain things that don't qualify for the 130% relief, but the uptake of the 50% relief is likely to be limited to larger companies and groups, given that the annual investment allowance provides relief at a rate of 100% up to the first £1 million of qualifying spend. Reminders of other key announcements from the spring budget include the temporary extension to loss carryback claims, which are allowing businesses to carry back losses incurred in accounting periods ending between the 1st of April 2020, 31st of March 2022, for up to 3 years. And of course, the increase in the corporation tax rate up to a maximum of 25%, depending on profit levels. So the first poll, and this relates to what we'll be considering in the following slides. So slightly mean to sneak it in at this point, but keen to get people's initial reaction. Do we think that the changes announced will make it more favourable to operate on a self-employed basis or through a company over the next 2 tax years? So yes, self-employment is better. No, company is better. Let's see what's come through with the results. I don't know who's in the attending the webinar, but a classic accountant's response wins out, which is unsure or it depends. So we will see. But looking at the other 2 answers, we've got more for no that company will win than self-employment. So we will see how that pans out in a moment. At the second poll, if you are operating through a company, do you think that extracting profits through dividends is going to be more efficient than using salary or bonus? And yes, dividends, no, salary, in light of the corporation tax deduction it affords. Okay, the answers there, very mixed answers. So dividends 38%, salary 24%, and unsure 38%. So we have done some calculations based on numerous assumptions and sweeping generalizations, but we have looked at the situation where we have a trader who's making £100,000 worth of trading profits, and on the assumption they will extract the profits in full if they are using a company, and that they will do so via a dividend route. So we have the three columns. The first one there reflects the position of a self-employed trader, and of course factors in the increase in the national insurance rate, subsequently known as the health and social care levy. The second column deals with the position for a company taxed at 19%. So we've said that would be a company in 2022 to 23. Again, we've borne in mind the increased rates that will apply to the taxation of dividends. And in the right-hand column there, we've got company, which we've taxed at a 25% corporation tax rate, reflecting the mainstream rate which will be in place for 2023-24. Although I should say this was simplistic, and if there were no other factors, a standalone company would benefit from, would fall into the marginal band at that level. So it wouldn't be a flat 25%. You can see the figures there, and if we can move on to the next slide there, I think what you see is for 2022 to 23, a marginal benefit can be shown through operating through a company in terms of post-tax returns to the business owner. But by the time we get into 2023-24, with a corporation tax rate of 25%, purely on the assumptions that we've made here, operating through a company would be more costly, and subject to the cap. Whilst we've made the caveat about the rate that a company may be taxed at in that period, the marginal nature of the benefit at 19% certainly helps reinforce the point that a presumption towards incorporation being tax efficient certainly needs to be challenged in light of what's happening with the tax rates. What I should say is that there are so many different variables that can affect the position that professional advice should always be taken before deciding upon a choice of business structure. And in addition to the tax points, there are a number of non-tax considerations. First and foremost, the fact that trading through a company provides limited liability probably also increases the administrative burden on the business owner. The last point on the slide there, we haven't shown any calculations in respect of the dividend salary comparison, but we have reworked a number of calculations we've done at a previous stage, and in each of the cases we had, there was still an indication that, notwithstanding that salary or bonus provides a corporation tax deduction even into 2023-24, there is likely to be a tax efficiency through the use of extraction of profits through dividends. So moving on to employment taxes, the van and car fuel multiplier is due to increase in line with the consumer prices index, and the amounts are shown there. Something which will be increasing well above CPI and inflation is the increase in the national living wage, or the national minimum wage, from next year. And in particular there, if you're looking at the national living wage, which is what the national minimum wage for the over 23s is known as these days, and there's a 6.6% increase in the minimum pay level. So generally excellent news for employees who are at the minimum wage or close to it. Perhaps not quite such good news for people who operate in business in sectors where wages are generally towards that level, including some of those which have been badly affected by the COVID pandemic, such as hospitality and leisure. So in light of the proposed substantial changes to the national minimum wage, national living wage, the question we'd like to pose is, do you think that the rise in national minimum wage and national living wage is likely to increase the risk of non-compliance with that legislation? Yes, and I'm slightly surprised by those results because I thought it was more of a rhetorical question, but intrigued that it's only by a 54% to 46%. So full credit to everyone attending this webinar who's clearly very much on top of things. Just a summary of some of the consequences for businesses which have found not to be. Those consequences have included obligation to pay back pay at the current enhanced rates, the public naming and shaming of businesses who have been found to be non-compliant, significant fines and penalties, and the reputational risk that comes from all of that. HMRC provided an update that in the latest round of naming and shaming, 191 companies were named for a failure to pay £2.1 million over 34,000 workers. And recapping some of the main reasons that have been identified for non-compliance, 47% wrongly deducted pay from workers' wages, including for things such as uniform and expenses. 30% failed to pay workers for all the time they'd worked, which might include times when they've done overtime or times where they're required to come on site before their shift actually starts. And 19% paid the incorrect apprenticeship rate. So being a little bit more cheerful, there has been some good news on the creative industries tax relief, which the Chancellor has done in order to provide a helping hand to another sector which has been badly affected by the COVID pandemic. The museum and galleries exhibition tax relief was due to come to an end next March, but that relief has been extended for a further 2 years. And from yesterday, the headline rate for the theatre tax relief and the museums and galleries relief will be subject to temporary increases, which will then be reduced, and those rates, current rates for next year and rates for the following tax year, are given in the table below. In terms of research and development, which was highlighted as a key priority in the budget speech, there is to be reform of that. Keeping pace with technology, it's recognised that qualifying expenditure will be expanded to include data and cloud computing costs. But there is also an intention to refocus support towards innovation that is actually taking place within the UK. Now, there are no details about this at the moment, but further details are expected to be confirmed later in the autumn, with the changes expected to take effect from April 2023. And last but not least, to help other sectors who have struggled recently, the government has carried out its review of business rates. The main changes to come out of this include a reduction in the rate revaluation period, so that now revaluations will take place on a 3-yearly cycle rather than 5 years. From 2023, there's an extended freeze on the business rates multiplier, which will be now carried through to March 2023. A new business rates relief of 50% was introduced for eligible retail, hospitality and leisure properties for 22-2023, subject to a £110,000 cap. And we know that from initial feedback amongst our clients in those sectors, that has been positively received. Looking to the future, exemptions were announced to from 2023 in relation to property improvements and investment in renewable energy. It's expected that here the government will announce further details of these measures in due course. I'll now hand back to Richard for the Q&A session.
Thank you, Dominic. And thank you, Chris and Sally. Excellent timing, as always. Right, this is the really exciting part. So we have got some questions to consider. So the first one, I think, is for you, Dominic. Why have they kept the annual investment allowance at 1 million when the super deduction is already in place?
Well, I'm definitely not complaining, and I don't think lots of businesses will be. I think it's really good news. First of all, the annual investment allowance covers a range of expenditure which is broader than what is covered by the super deduction, which has a number of restrictions on it. So that's helpful in the period between now and March 2023. And also, I noticed in the budget paperwork, there was a suggestion that the annual investment allowance would then return to its what was always planned to be its permanent rate of £200,000 per annum. But whilst that would be a reduction, I find that quite encouraging, because I know there have been some speculation that with super deduction coming in, albeit for a time limited period, the annual investment allowance might at some stage be removed, maybe as soon as January. So I think the coexistence of those reliefs and then the prospect of the annual investment allowance continuing beyond that is very good news indeed.
Thank you, Dominic. Capital expenditure is a long-term decision, and therefore it's good to know that the policy is there for the medium term, and at least businesses can plan their capex and hopefully maximise the tax relief. This one, I think, is for Sally. To fall within the rules for MTD, would multiple employed income be added to the self-employed income, where the self-employed income is under the 10,000 limit, but employed income exceeds it? Sally.
Thanks, Richard. Yes, so you wouldn't fall within the scope for MTD. It's only self-employed and rental land and property income that gets taken into account. So the fact that you have employment income, that wouldn't be looked at in the test. So good news for you, you won't be caught by the new requirements.
Whilst you're there, Sally, another one for you, I think. On partnerships, what happens if each partner has a share of more than 10,000 turnover in tax year 2024-2025?
So for the 24-25 tax year, they won't be within the scope for MTD, because partnerships don't get brought in until April 25. Once they hit April 25, then all partners will be required to submit the quarterly returns. We don't know exactly how that's going to work yet. There has been some talk that, like with the partnership tax return, you have a nominated partner who's responsible for submitting that each year. It is thought that maybe the nominated partner will be able to do those quarterly submissions on behalf of all the partners, but hopefully as we get closer we'll get some more guidance from HMRC.
Thank you, Sally. Chris, I think it's your turn. I'm a member of a trading LLP. Is the LLP included in the new basis period reforms and MTD?
Good question. LLPs are included in the basis period reform, but not in making tax digital for income tax self-assessment at the moment. But it is proposed that LLPs will eventually be included. So everything will be aligned in due course.
Okay, and one more for you. Chris, you mentioned that the deadline for reporting and paying tax to HMRC on disposals of UK property are increasing from 30 days to 60 days. I sold one of my houses, so residential property, at the end of last week. I wonder whether I can use the new deadline.
That's another good question, actually. I think you need to differentiate here between exchange and completion. For this type of reporting, what we're looking at is the completion date rather than the exchange date. So typically estate agents and solicitors like to complete on a Friday. So you said you sold your property at the end of last week. Let's assume for a moment that you completed last Friday, in which case you would be within the 30-day filing deadline. On the other hand, if you had deferred until this Friday, then you would be within the new 60-day reporting.
Thank you very much. I don't think we've got any more questions coming through, so I think everyone's probably keen to have some lunch. So I'd just like to thank everyone for their time and attention today. I hope you found something useful there. I'd like to thank the presenters, and I'd also like to thank the support team at Larking Gowen, who've been putting sterling efforts in to make sure that this all works smoothly and that you get the messages and the information. Just to repeat what I said at the beginning, there will be a recording of the webinar and our budget brochure on our website shortly. We will send everyone on the attendance list a PDF version of the budget summary within the next 24 hours. And if you do have any questions that we didn't manage to get to today, then you can send the questions in to the email budget@larkinggowen.co.uk, and we'll do our best to address those when we get a chance to consider them. But otherwise, it's for me to say thank you for your attention and do have a good rest of the day. Thank you.